Welcome to today's webinar, Why Integrated IT Portfolio Management Matters. My name is Chris Dawson with eMedia, and I'll be your moderator today. We have a few instructional notes and announcements before we begin. The slides will advance automatically throughout the event. You can ask questions throughout the event by typing your question into the question tab on the left. We'll do our best to answer those questions at the conclusion of the presentation. If you would like to watch this presentation again or share it with your colleagues, it will be available in approximately 24 hours. We will send all registrants an email as soon as the webinar is available for on-demand viewing. Today's speaker is Mike Gruia, CEO of UMT360. Mike has long promoted the strategic use of advanced methods to transform the way corporations operate and invest. Mike has led major assignments for financial, pharmaceutical, utility, and manufacturing organizations and directed the development of a series of successful software products, recognized as innovative by leading industry analysts, including Portfolio Manager, which was acquired by Microsoft. This webcast is sponsored by UMT360, an organization committed to enterprise portfolio management solutions that helps companies transform the way they manage their product, project, application, and IT service or portfolios. UMT360 has been recognized by Gartner as a cool vendor in PPM and positioned as a visionary in the IT PPM and integrated IT portfolio analysis Magic Quadrants. With that, Mike, over to you.
Hi, thank you. Good morning, everybody. And to today's subject, the integrated IT portfolio management, it's a subject that I would say I spent the last 20 years. So I hope that you're ready to listen about the secrets of digital investments, what are the considerations of implementing digital investments, and finally, how you might evaluate whether to embark into an enterprise portfolio management journey. So here is a graph that I'm looking at it, and it's quite amazing. And there's a quick explanation on the vertical axis. What you see is the productivity index, and we have a chart of productivity over the last 50 years. And it's amazing to see the graph going up and up. And I think we're living in exciting times. Technology is changing the way we work and the way we live. It's an interesting thing. Just think about what it took an average American in 1950, the work that was done in 4 hours, today is done in only 11 hours. So today you hear people talking about second machine age, and an age that we're going to blow past previous limitations. We'll be using the big data, the cloud, and the social, and this gives us a chance to imagine an entirely different kind of enterprise, an enterprise where business has unlimited capability to use technology to compete. What we see an amazing transformation taking place. It's just as easy to generate an idea and to implement it. So what could possibly go wrong, right? You innovate, you implement, you make money, and you go home. But there are a few things that they might go wrong, and let's examine them. The first one, which is fundamental, the business growth rests on a strong ability to invest. The trouble is that for some companies, there is not enough money to invest in growth. And as you look at this graph here, which is based on some studies from Gartner and our own experience, you look into a company over the next 5 years, or the last 5 years, and you can see that the demand for growth is increasing and is increasing and is increasing. The only problem is that the capacity for growth is decreasing. So here is the dilemma. Yes, we have great ideas, but the available capacity for growth and transform is shrinking. The problem is that it's very tough to offer new ideas for innovation to an enterprise there has an increasing amount of investment already in IT. And these investments require continuous investment to maintain. So what I'm really saying that the run the business ratio of the IT investments over the past 10 years, we see them also going up and up. And right now they're an all-time high. The grow transform, and this is the innovation. This is what is really the excitement in our economy. We've seen them an all-time low. So the concern is that the run the business consumes all IT spending. And I'm going to show you today some methods, or I'll get you to think how you might be able to address that. So let's go to the second dilemma, or second issue, is that, well, to manage our investments, I think we're using different type of project portfolio management techniques. However, we see something that I don't think we have any doubts about it. The traditional PPM is failing to deliver anticipated results. Just think about it, that for every dollar that we invest, only 54 cents are realized. 46% is unrealized. You keep thinking, why? Well, there are many reasons, and I'll touch on them a little bit more afterwards, but there are more statistics that perhaps will get you to think in the right direction. 80% of the projects fail to get completed or implemented. And 43% of the projects are delivered late and over budget. Well, so let's take a look, and I'll share with you how you might want to address the situation. I label this as the secrets of digital investments. And there are 5 things that I'm going to touch on them, very brief here and then in detail afterwards. But as I was preparing the presentation, I kept thinking, why all these are happening? I mean, I can give you 5 ways that you can fix it, but you might ask, why? And I came with 3 reasons. One of them that our organization, they are not designed for a network organization. And furthermore, they are not designed for a network organization that operates at high speeds. And finally, the financial management practices, they are very good on the operational level. But again, they're not designed for programs, portfolio, and assets. And we have some capabilities that I'm seeing today on a project level, but again, not in the aggregated level. So, with this being said, let's take a look to the 5 of them. The first one, I labeled integrated investments. Actually, the problem is that we have a silo investment system. Organizations make decisions in a silo mode. And by doing so, all the interdependencies, they are not considered. And what are these dependencies? Well, we're not talking only projects. The projects, they don't live by themselves. We're not talking only about assets. They don't live by themselves. It is a world, the business world, where we have business capability or processes, and to have applications, and to have infrastructure, and to have projects, and maybe services, and all those things, they work together. Second, I'm talking about financial maturity. Actually, the problem is lack of financial maturity. And one of the things that I'm seeing is that failure to understand the financial aspects behind the IT investment model. In other words, we're seeing only a portion of this investment model, which is on the project world. I have a concern about the implication of using incomplete financial data. And in many organizations, if I'll ask the question, what's the total cost of ownership or total cost of IT, I doubt that the answers, they will be clear. And the third point, transformation roadmaps. Well, for some reason, which I think I understand, organizations lean towards a simplified view of their investments. And when I say simplify, doesn't mean something good. It means that they will focus on single projects time views, like the things that most of you are familiar, the Gantt charts and all the things. Well, the problem is that they worry too much about the task dependencies and ignore the business application projects and infrastructure life cycle dependency, because everything works together and everything works with one time frame. And finally, actually, number 4 is the agile investment and resource allocation. Many of the organizations that wish they'll have an agile resource allocation. Most of them, they have a static resource allocation, where in a world that the business and technology is changing fast, the resource allocation is not able to change and to follow. Unforeseen business events are happening. Unexpected project and resource changes are happening, and we're not able to react to that. What happens if a project comes in midstream after you really have your whole portfolio? What you going to do? We're going to tell this project wait till next year, perhaps. And finally, as any management system, we cannot have a conversation without talking about performance. But here again, I have some doubts that the performance is, we're doing this at the right level, because most of the performance management is at the project level or at the asset level. So my question is this enough? So let me move and explain some of the things that I mentioned here. And I'm using here some prints from the software that UMT developed. And I'm doing more than anything else to give you an idea how some of the things I will mention today, they can be viewed or they can be implemented. So we'll see, we're living in a world that is possible. What we really found out, that the best EPM performers, they use a portfolio integration model. One that allows them to understand how processes using applications, how applications, they are using infrastructure, and how projects are changing both applications and infrastructure and perhaps processes. But if you don't have a system or a model to model that, I don't think you can analyze that. And there is more to that related to innovation. Keep this in mind, and I will touch on that. And the second thing is, as the priorities are changing, how an organization that is changing its priorities, how the changing priorities will be reflected at the application level or at the project level. And perhaps, because we're living in a world of dynamic change, how the impact of change will affect our investment model. I'll give you a very simple example. For example, from the top, perhaps an organization is going through a merger. And the question is, what will happen to the applications? What will happen to the infrastructure and to the project? And maybe a bottom-up change. An organization decides to refresh their technology. So the question is, what's the impact on the business, on the application, and so far? So you can see that the integrated investment is a must. The second thing, which is very dear to me, is the financial transparency and insight. Yes, this is an additional source of differentiation. And the model organization that they have this type of thing, they're able to calculate the total cost of ownership, the total cost of IT. They're able to calculate the amount of infrastructure allocated to each application. And perhaps, and that's a very important thing, they will be able to articulate the benefits they could be realized from investing in change. So, transformation roadmap. Well, without the transformation roadmap, it's like having local optimization models. In other words, you're seeing only one portion of how things will happen over time, instead of seeing a global. And you need to see the global because you need to see how product deadlines and business deadlines, they align with application cycles and with projects. You need that because also it's like a traffic controller. You're trying to avoid costly collisions of many things happening at the same time, and then perhaps at the time that you're releasing a product and everything falls apart. And finally, and this is extremely important, this type of roadmaps eliminate delays. And right now, let's go to the resource allocation. What I think really happening, the traditional resource allocation actually is not bad, and it works for business that perform according to schedule. I don't know many businesses that are like that. And unfortunately, cannot handle the challenges of mounting complexity and rapid change. Here is an example that I borrow from Frank LaRocca, which is a senior IT executive with Con Edison in New York. Frank instituted a sweep process at the energy company where on a quarterly basis, they review the health of each project, and then they summarize at the project level and say, okay, if you're not going to spend the money, we suggest strongly that you release the money back into portfolio for reinvestment. That's one of the examples of dynamic resource allocation, and there are many. The result has been, in his case, the millions have gone back into the portfolio throughout the year, and they were able to fund projects that otherwise they would be never possible. The swing process has been so successful that they extended from a $200 million portfolio right now to $2 billion portfolio. So the agile or dynamic allocation of resources is an ongoing process of searching, allocating, learning, and modifying. The system offers solution to problems that we know for some time. People have talked a long time about increasing speed of business and the need for organization to be quicker and more agile, and this provides a solution. Finally, we need to talk about the measurement system. Many of us know, and I also heard, many complaints about a lack of metrics to manage. That's not something new. However, in the past, most of the attention has been on the individual investments. And you see here on the left side, those are the individual investments, and they are related to the application status equivalent to a project. They are looking for variances, cost variance, time variance, and any type of things. And that's fine. I mean, I think we need it. But I have to warn you that investment performance has become so specific in some organizations that it's impossible for any individual to understand what the hell is going on. In other words, they know what each asset is doing. They know maybe which project is doing, but they have no clue if everything together is moving forward or not. A fellow that I read some of his stuff over the last 30 years, and some of them he's an economist, but he wrote a few things also in management science. He said something that I have to read to you. What information consumes is rather obvious. It consumes the attention of its recipients. And he continued to say, hence a wealth of information creates a poverty of attention. So focusing on asset level measurement obviously is not enough. You know why? Because strategies are not impacted by one project, by the whole portfolio. And the ability of an organization to change the portfolio mix or the resource of its workforce, it's a portfolio level decision. Here on the right, you can see an example of a portfolio level metrics. Here's an organization that is using the run, grow, transform to set goals for cutting costs on the run and increasing the investment in grow and transform. So what they are doing in effect? Well, they are cutting from the past investments to fund the future of the enterprise. They can either keep the thing flat, the whole spending, or they can just rebalance the run, grow, transform. And they are doing this over 3 years. They are getting the run down from 73 to 66%. Key takeaway from that, you need both specific investment portfolio level. One is more tactical, focus on the current year, and the other one is more strategic, focus on multi-years. Now let's go to a poll. Chris?
Absolutely. So let's turn this over to the audience for a couple minutes. What factor does your company currently struggle with the most in terms of digital investment? And guys, just go ahead and feel free to pick a choice here. We'll give you a few moments. One of the choices is integrated investment. Another is financial maturity, transformation roadmap, agile investments and resource allocation, or performance measurement at all levels. And although many people may struggle with all of these, let's pick the one that is the most troublesome for your organization. I'll give you another minute to answer, and then we'll take a look at these results. All right, so looks like number one, we've got agile investments and resource allocation. Is that any surprise?
No, actually, I'm not surprised. And the only thing I can add to that a few years back, I asked these questions, and I didn't get this type of answer. And I have to admit that I wasn't also aware of the importance. But as I'm experiencing and talking with many companies, starts to make a lot of sense. Well, what I'm seeing here also, and I'm pleased with that the integration, the notion of integration, is very strong. And you can look to the notion of integration not only in terms of investment, but actually the transformation roadmap is an integration over time. So both of them, they are important. I see people being concerned with the performance measurements. I don't see enough on the financial things. So either it's not important for most of the organization, or is relatively less important, or is more important to the other people in the organization.
It really needs to be a holistic solution, right, where we're looking across all of these items.
Absolutely. Absolutely. Just getting one of them right is not enough. But you need where to focus, and you need to think, how am I doing in each one of those? And perhaps this will give you an indication where you need to focus. So we're going to move next. And I keep thinking, all right, if I have to go ahead and implement a new PPM model, I call this a digital investment, what are the type of things that I need to worry about? And there are 5 things. One is the digital investment model. And this one, I talk about it a little bit, and I'll say a word or two afterwards. But that's not enough, because one of the bigger things getting into this digital age is innovation. So I'll have to say a few things about innovation. I think they're important. Also, I'll give you a clue how you can evaluate if the current technology that you have might get you there or not, because we're moving from what I call automation to something that is a little bit more cognitive, which is sounds the same, but is, I would say, significantly different. And the next question is your organization structured the right way? And finally, because we're seeing shift in control, how are you going to deal with some of these shifts? So let's start with the digital investment. Actually, here more than anything else, it's a summary of some of the things that I did the last 5 minutes. But I try to put it in a way that maybe makes more sense. You can see everything how here is integrated, from strategy to business capabilities to application and infrastructure and the programs and projects. They are impacting everything. And what you're seeing here is not only a functional thing and priority, but for example, the green circles that have a dollar, they imply that, it's an investment model that has also a layer of financials. The T in blue stands for time, so it's an investment model that has to respect time consideration. And the R is an investment model that has to consider resources. Actually, you're going to ask yourself 5 questions. I think this model will help you. How it works, what is important, how money and resources are allocated, when things have to start and end, and what are the constraints. Organization will face an increasing number of complexity today and business disruptions. Our model will focus on not only managing regular change, but will allow a way to understand and to address disruptions that could be at the business level, could be at the technology level, environmental, or regulatory. Go to the second thing. The sources of innovation. Well, I love that. A few years back, somebody at one of the Gartner conferences asked one of the analysts how we can be more, how can we have better innovation? And I didn't hear any answer that I can do anything with that. And I didn't know also what is the answer. But as all of us know, the viability of a company depends on innovation. So the first thing that I will ask, where the information comes from? Well, it comes from 3 sources. Top down. Most of us, they are familiar with that. They are driven by a management imperative. We got to do that, or we got to do that. How are you going to do it? Bottom up, start with a clean piece of paper. And many times this sounds transformational, but from my experience, the best is imitational. And then there is something that we don't have a lot of experience. I mean, we have a little bit, but I haven't seen a lot. And I call this the middle. This is the core innovation. There where the effort is to make incremental changes to existing applications. Such innovation draw on the assets the company already has in place. In contemplating the balance between these 3 types of innovation, you need to consider your success rate and decide where you need to focus more. The challenge, in my opinion, is that it's not enough the middle core innovation. And I'll tell you a secret. If you want to increase the middle core source of innovation, you got to improve the integration. Otherwise, it's not going to work. Because most of the middle core ideas come from existing assets and the relation between them. Linus Pauling said, if you want to have good ideas, you need to have many ideas. I will add to what he said that you got to have many sources of ideas. Let's move to the next one. Talk about technology a little bit. Today, the EPM digitalization problems cannot be solved by the yesterday project management tools that they were built in the 90s and before. Because it's a simple reason. These tools, they separate new investment from current investment. And the PPM type of thing, which are new investment, they are handled by the PPM tools. The old investments, they are handled more by the EA tools. In the digital age, we have to think differently. We have to build our thinking and our models and our system from the ground up and in a way that they fit into the digital age. It's extremely important for you to understand the difference between project management type of things and the EPM, which is the integrated type of things. What I provide you here, and you'll have it, it's an example of the things that you might want to consider at different stages, processes, and I provide a comparison, and you need to do on your own with your own tools how different stages and processes in the investment model are being handled by the EPM vis-a-vis the project management type of things. So I'll give you an example how to look at it. For example, I've been talking about innovation for quite a while, which is about creating investment opportunities. In the PM type of tools, they cannot help you too much on that because they're not integrated. On the opposite, on the integrated, the EPM type of things, yes, this can help a lot. Second, I'll be talking about funding and dynamic allocation. Many of you want to do that. Well, guess what? The project management and the PPM type of things, they don't do this well. And finally, I choose change management. The change management, the only thing that the PM can do well is looking to changes in time and maybe at cost, but they cannot talk about the impact of the total system of change, and they cannot help you if you want to stop a project, if you want to change the pace, and things like that. So technology that can digitalize enterprise investment, cognitive task, and that's what I'm talking about. That's the one that I think is the right one. It's much more important than the technology that automates computational tasks, such as scheduling. We'll go to a new poll. So, Chris.
Excellent. Yes. So now the next question is, which best describes how your company currently uses tools to manage IT investments? We have 4 choices here. We use a PPM tool to manage projects and programs only. We use different disconnected tools to manage investments in projects, applications, and IT services. We use an enterprise architecture tool to manage investments in projects, applications, and IT services. We use an integrated IT portfolio management tool to manage investments in projects, applications, and IT services. So a few choices there, some subtle differences. Be curious to see what people think. Mike, do you have a prediction here where this is going to come out?
I have no idea.
I wish we had a crystal ball. It might be a little easier for folks here. All right, I'm going to go ahead and see what the answers were. All right, so really dominant. We use different disconnected tools to manage investments in projects, applications, and IT services, which actually sounds like a pretty typical story, right?
Yes, indeed. I didn't want to bias the response to the polls, and I like to see what people think. It's interesting that I don't see, well, maybe it's good to some extent, I don't see people that they try to use enterprise architecture tools to solve the investment models, although I've seen some of those also. And I see that
yeah, we definitely see some people using the PPM tools. Certainly, that's not surprising.
Yeah, it's so 71% they use different disconnected tools to manage the investments in projects, applications, and IT services. Well, I guess some of the statistics that I presented in the beginning, they shouldn't surprise anybody.
No, absolutely not. And these disconnected tools, they can certainly be a source of challenge as we go. So what else do you have here as we ponder these results a bit?
No, that's the most, we can talk about a lot of things, but it is obvious that the people attending this webcast, they know what they got, and perhaps they know what they want to do. So let's move to the next one. We should be able to finish on time. So the next topic is, it's an important one, because we keep talking about process, technology, everything, but the question will be, what is the right organization structure? Is the current organization structure and thinking the right one for your organization? And what I'll suggest again, I listed here different processes. I suggest to evaluate the current structure against major processes like the one listed here. And you got to figure in your own mind which one works better. Let me help you here a little bit. So let's take innovation. By now you're becoming an expert in innovation. On a project-based organization, the innovation is usually bottom-up and created and selected in isolation and not tied to the business operating system. In a product-based PPM, and I've been fortunate to work in some of those, it is top-down and middle, and is customer-focused and derived from the business operating system. For example, the selection, how we know which projects are worthwhile to be selected. In a project PPM, usually it's binary, selected or rejected. In a product organization, is driven by business outcomes, and the decision is how much to allocate to a product or asset. Then you move to consider alternatives. And finally, the funding. In a project type of thing, it's once a year. Ideas sit in a queue for months. They might require additional time to move to implementation. In a product, it's dynamic, it's just in time. The project-based investment thinking is focusing on creating and managing a portfolio of projects that have a beginning and an end. Again, I repeat, beginning and an end. But it's time to challenge the project-based thinking. Projects are not discrete investments, but they are releases of a huge flow of investments that improve the firm capabilities. This is not discrete events. They are there to improve firm capabilities, which is a fluid thing. It's more like a product. It is more like a product. Even though you're not a product company, many of the capabilities, like a trading system or an accounting system, they are capabilities that your organization has as it's trying to improve over time, and it's improving to different releases of projects that they make these capabilities better. And right now, if many of you are from IT, I'll expect you to ask the question, who's managing the IT investment today? From a recent survey that I got from Gartner, we see the good news is the majority of organizations still managed by IT, but close to 40% are outside of IT. And we see also that the IT control has been reduced over the last 3 years by 15%. You can see the graphs in different colors, and actually I have here the statistics by different industry. So we expect that the business will increase their influence in most of the investments. And if IT will do nothing, they will, at the end, they will maintain and control the execution only. And, you know, the CFO does not abdicate finance to business, neither the chief marketing officer or the head of HR. So what I might recommend here, two things. You should not give up control over IT investment and find the right balance of control. And you need to combine IT and business under one type of steering and sharing, and define the roles and accountabilities of the participants in this governance thing. So let's go to another poll, Chris.
Very good. So implementing digital investments, what factor do you consider to be the most important in your organization? Do you look at a digital-enabled investment model, EPM investment model? Do you look at innovation, EPM technology, the organization, or control? As you mentioned, you're not giving up control. Folks, go ahead and submit your answers. We'll give you a few moments here, and we'll see what comes out of this. This is a very interesting question because this is what it all comes down to, right, is actually deciding how you make these investments. And it's looking at the big picture, of course, but there has to be some pieces that get you from point A to point B. All right, we're going to give folks about 10 more seconds here, see where these answers come in. All right, this is a little more even spread than we've seen already. It looks like innovation is right up there, the organization itself, certainly, and then digital-enabled EPM investments coming there. What do you think, Mike?
I'm not surprised because those, they are all important, and what I really like, two things that I see here. One, the innovation seems to be there with the 28%, and closely the organization, also around 28%. So people, they get it. They get it that you cannot get in any place today if you want to grow without innovation. And also they get it that they need to pay attention, is this the right organization or not? So the results, actually, I like them. They are not one-sided, which I would say, why only one thing? So it seems, at least from my perspective, that I'm touching on most of the things, hopefully, that they are important to the organization.
Perfect.
So we'll move to the next one. And here the question is very simple. Should you invest or not into digitalizing your IT investment process? What I did here, I show an example how you might want to do that. And you might want to use that or something like that. And you need to look to two things, perhaps, to ask two questions. The first question is very simple. How the investment digitalization that you're going to go into improves the investment effectiveness? Are you able to increase the yield of your investments? So my perspective on measuring things and evaluating, use a few metrics as possible. I wish you could have only one, which maybe you could, but they give you here some possibilities. So, for example, the total savings or improvements, the ROI, the average yearly savings, the cost of waiting or postponing, and the investment risk. So here we have, for example, a company with about 500 million with a total IT budget, with about 125 in projects, and the run spend ratio of 75%. And I calculated a few of the metrics, and you can see that the ROI on the one scenario, where everything will happen on whatever you estimated, then it's a huge ROI, almost illegal, and even only 10%, it's a huge ROI, which is, again, it's big. So you can see that under all conditions, even under the most pessimistic conditions, it seems that it makes a lot of sense. But I have to warn you, you're going to run your own numbers and to see if it makes sense. Even more, equally important is the cost of postponement. In other words, not doing anything is anywhere from spending $1 million a month to over 125 a month. So there is a cost of not doing anything. In additional, I answer a different question, or suggest you to answer a different question. How the investment digitalization improves the management effectiveness? Are you able to decrease the cost of operation of the investment and the governance? And I give you some examples here that you might want to consider. Reduction in admin time, reducing cycle times, and reducing unnecessary portfolio governance meetings. So, as I'm concluding today the presentation, hopefully I would love to have a conversation. All of you today, you carry a very heavy burden. You are responsible for managing a huge enterprise investment portfolio. Given the size of this portfolio, you might well change your role and your job, and you might want to call yourself an investment officer. That's a great opportunity exists for all of you to lead the digital revolution. Take control, use the digital ICPM to make the investment calls, and lead your company into the future. Thank you.
Excellent. Thank you so much. We do actually have a couple of questions, I think, just about how to go about that and some specifics from your presentation. So the first question was, you mentioned a roadmap sync that creates deadlines and landing zones that impose discipline, avoiding costly collisions, you said. Can you describe what you mean by costly collisions?
What I mean a costly collision is that what we have, for example, I know about an organization that I've been involved with, and they had two major projects that they started within 15 days. And both of them, they required the management attention, and the end result was that, I won't say that both of them failed, but they got delayed, and there was, I would say, that the major effect. This organization was releasing a cloud thing, and they missed their deadlines because each one of them had a myopic view of what was going on. However, if they would have a capability of seeing everything together, this is like in an airport. I mean, a traffic controller, you might not see the two planes that are going on the same runway, and if you are able only to see one set of planes and not the other ones, then things can happen.
Absolutely, you need that visibility. It makes sense. Well, thank you to Sandeep for that question. We have a question from Frank here. How can an organization standardize metrics across their various services, whether projects, applications, or something else? And are there best practices or tools for this?
Okay, there are some tools, and I think that an organization needs to approach the measurement in two steps. First, they need measurements on the individual level. So I never said that you shouldn't, and I think you need to develop. And I would say another thing, and that's a very lengthy conversation that we can spend an hour, but the number of measurements actually needs to be minimized, because the question is what you're trying to measure. And the things that people measure, they manage cost, time, and yield. And perhaps they measure other things. So, but all these three, they transcend also on a portfolio level. Because on a portfolio level, yes, you want to know the yield of your portfolio, of your program, and so far and so on. And you want to know the cost and the cost variance. However, on a portfolio level, you measure something else different. And that makes the whole thing a little bit different, because at the portfolio level, you made a decision without knowing, perhaps, and sometimes with knowing. You're moving your organization into a certain rate. In other words, you keep going up to 75 or 80% into the run type of investment that they are easier to justify and they are more alarming. And when I say perhaps, because everything in evaluation of projects is not only things that they are really clear, there are things that are perceptions. So you keep doing the 75 or 80% game. You starve the organization from funds, from grow and transform. However, the type of things that I'm talking about, you're not going to see them on a specific level. So I would say on the aggregate level, because that's what we're talking about, it's an important thing, because it's not only that you aggregate project yields or you aggregate cost, you need to look to the strategy. Am I currently, my run, grow, transform is the right way I'm going? Then it's not only about run, grow, transform, because sourcing is another strategic decision. Is the onshore, offshore, and inside the right type of strategy? Because this type of thing really has implication not only on cost, but has implication on the freedom of an organization to change and to move from resource to worry about resources and worrying about money. So both of them, they are important, but you need to understand why you're building them. Just building indicators is not a panacea for all these problems.
Makes sense. We do have a few more questions coming in, and folks, don't hesitate to submit a question over the next few minutes right within the questions and answers tab in your viewer. So the next question we have is from Len. How does a business begin to connect all of the disparate parts? And who do you think within the organization should be championing that initiative?
Okay, that's a loaded question. That's a loaded question. Okay. Let me start from the end, and then I'll go to the beginning. I just finished yesterday an article which I was writing, and actually was related to that, was related to the role of the enterprise architects they might play into this new world. And I keep thinking, who really participates here? What's the right thing? And it's definitely there are different organizations that they need to learn how to play together. And the first one that historically was doing some of those was the PMO, the Project Management Office, Program Management Office, whatever it was called. And then I'm seeing a new entrant that actually has a lot to offer is the enterprise architect, because they know how to build this mapping. The only thing that I have to warn against is not to fall in love with the diagramming and all these things, because we're not doing business transformation. We're just trying to understand what it is. So it's more of a high-level mapping of business capabilities to application, to infrastructure, and to projects. So the enterprise architects, they can play a major role. They can play also a major role on road mapping, because they understand how things will go into execution. And then you have financial analysts, which they might sit near the CIO, in the office of the CIO, and their task is to help to keep us honest about the financial transparencies and provide us financial insight. And finally, and it's extremely important, is the business. The business definitely have different roles. It has to be, even if it doesn't take responsibility for some of these tasks, he has to be informed and communicated about different things. And the business needs to know the total cost of IT. The business needs to know what will be the implication of moving to the cloud, and not the technical implication, because there is an economic implication. And the business needs to provide input on many of those things. So all these stakeholders, they need to play together. How you start something like that, I know we understand. How you start something like that, you cannot start in a project management tool. It's not going to work because this is not a scheduling problem, and this is not a calculation problem. This is more of a problem of understanding how everything fits together. So my suggestion is either you get a tool that can do this type of things. If you don't have a tool that can do this type of things, don't fall into the trap and hope that the project management tool, this will not do it. You might be better off, and I'm not advertising that to do it. You might be better off doing something in Excel, although this is going to fall short because you cannot share and you cannot manage the collaboration. So there are a lot of things that will fall short, but it's almost, I'm asking myself, get the right tool. If you don't get the right tool, wasting your time and money in the wrong tools is not going to do it. So you need to create that. But what is also equally important is you just having all this relation is not going to do it, because you got to understand how the money flows. So you need a tool that allows you to show how the money flows from the lower level, which will be, it's not lower level, it's not important, but the way I see them in the value chain, from infrastructure, from services, from projects to application, and how application consume all those, and how business process consume applications, and so far. So you need a system that shows you all that. And you need also a system that is not a Gantt chart. You need a system that shows how everything fits together. So you need to start. The way I'll do it, I'll build as much as simple as possible. In other words, simplify the whole problem. Don't try to go to end levels. Go to the minimum number of levels that you can afford, that you can start. Also, I might say that some of these systems, as you become more knowledgeable, the system might change. And you should be able to change, because the data that you have sits in different places, and maybe you're going to need to add more, and that's fine. You might want to go to lower level, that's fine. You might want to, at some point in time, and I didn't talk about it, you might want to consider duplication and reusability, that's fine. There are a lot of other things that you can go way beyond that. And I would say in parallel to what I'm describing, don't focus only on the model. You need also to look at the organization, because both of them, they morph into each other to some extent.
So that leads us to the very last question we have time for. This is from Janet, and I think she's asking us to get a little more specific because you mentioned Excel as a sort of a last resort instead of looking to project management. But she asks, what are some examples of enterprise architecture tools that can do these things or that can manage these multiple types of IT investments?
Well, I'm managing a company that created one of these tools.
It's okay. Go ahead. Give the shameless plug because I think there's actually a real case to be made for a unified set of tools. We only have a couple minutes. Would love to hear I think, and so would Janet. Would love to hear a specific recommendation.
Right. I believe that we did build one such a tool because we didn't start as a project management tool, but we started with understanding that you need to have an ability, like people they talk today of Internet of Things, an ability to have an enterprise of things and all things. And we've been fortunate because we've done something like that about 10 or 15 years ago when we embarked into the portfolio management thing. We created a tool that was called StratFriends, but attempted to do the same things. So Excel is not going to do it to a large extent. Project management, if you want to worry about execution, that's fine. However, there might be other tools. We believe that one of the few that took the right and the balanced approach, because some of the problems, I'm not going to talk about anyone in particular, some of the deficiencies that exist out there is either they are tools that are project management tools, and most of the tools, they ignore the financial thing. In other words, they go to a very low level of depicting all the financial numbers. And they are important because the whole conversation at the end of the day is about returns and cost. So ignoring that, it's one way that you need to judge. If it's okay for your firm, that's fine. And the third thing, I didn't find many of them that they go into a unified way of looking in terms of how all the investments they behave over time and not behave. What's their life cycle over time? So an ability, most of our, there is something that I guess many of us know. There are some assets that they live 10 plus more years. And there are other assets that they have a very short life cycle, which is less than 2 years. And some of them they have, so you need to understand how all this, they behave, what happened in their life cycle. And perhaps if the life cycle is even shorter, it's even more important to understand the replacement cycle. So I'm not aware of any tools that does everything what I described. I believe the only one that I am familiar, because I work together with my team on a design, the UMT360 is doing exactly what you're asking.
Very good. All right. Well, that unfortunately is all the time we have. Mike, thank you so much. That was a great presentation. I'm Chris Dawson. On behalf of myself, Mike Gruia, our sponsor, UMT360, and everyone here at eMedia, have a great day.